Hi, this is Randy Finney with Right Side of the Chart, and this is the early session update for Thursday, May 22nd, 2025. It's 11:16 a.m. Eastern Time, so I'm starting the video, so we're a little less than 2 hours into the trading day, and let's see if I can do one in 15 minutes or less. I'm actually shooting for 10, so we'll keep it a quick one. I'm going to go over the just the stock market in this one. That's the closest related thing that's not the market, and that would be the VIX. So let me just dive in here. This is SPY, the S&P 500. We're on the daily time frame, but these are the same targets that I've laid out for you starting last year. My long-term swing and trend targets, comparable to my targets on QQQ. Again, it's the same board. I can just toggle over. I shared it. I've been sharing that's the weekly. That's what it looks like. Here's the daily. I'm doing it on the daily chart just to highlight that we do have the majority of indexes and key sectors all below the trend lines now. If you recall, for the past couple weeks, for me, it was a no-go for adding to any shorts until those trend lines broke. Now, it also coincides with a shorter-term swing trade idea, but this is it. These are the uptrend lines off the lows. I'm talking about the April, I think it's April 6th or 7th low. What is that? 7th. April 7th low, and that's it. So let's just go through this quick. To kind of summarize, we had big divergent high back here, big primary uptrend line, basically a giant bearish rising wedge, breakdown of those giving you a major sell signal. Also a break below the trading ranges we had on QQQ and SPY. So we had multiple sell signals there. We took out the 200-day moving averages. We gained that little bounce back, shorted back on the back test of the 200 simple there. And then we had that big drop on that day, on that very day. I had stated covering all shorts and going to a full long position with no hedges, April 7th lows. So gamed up most of that. And here we are. So we overshot my scale back in zone by a little bit. Again, everything is relative. When I say relative, relative to what? Obviously, relative to the scope of the move I'm looking at. If you're like me, taking a longer term view of the market, relative to the 50% drop I'm calling for, we're only over the 200-day moving averages, about 3.5% at the highs right now, less than that. So here it is. I'm just going to go through this quickly. Check mark, right? We broke down yesterday below the uptrend line in SPY, and we're clearly below today. Nothing, that doesn't guarantee anything, and but it is what I've been waiting for. And also you have not yet, as I mentioned earlier today, on XLF, and I'll get to that in a second when I do the sectors, you have a pending, what I call high-level bearish PPO crossover, meaning well above the zero line, and you can go back as long as you want. I've done this many times, and look and see what happened. Put the crosshairs when we get those high-level bearish PPO crossovers. They're very effective trend change indicators, and we had them there, at all these major inflection points for the trend. Those were just corrective waves or corrections that came after an uptrend. And so at minimum, looking for a correction, although guys know my longer term view, I'm looking quite likely for the end of a bear market rally that just kind of pushed the upper limits of what was expected. Again, just relatively a hair above my expected bounce target zone there. And nothing's changed. We power on through there. Yeah, it's going to continue to chip away and decrease the odds, or increase the odds, I should say, of going to new highs. And I've talked on that recently. What will happen if that does occur? It will simply be a bigger divergent high, setting the stage for most likely a bigger drop later. But in the near term, you may not want to ride that out. QQQ, check yesterday. Here's the uptrend line. There's your solid close below it. And we're still below it today. Markets are flat today pretty much. And that was, again, the big key trading range right there. You had a lot of support right here, about 511.74. And that's what we've been dancing on. So that needs to get taken out and open the door for the next move down. Got a big old gap there, the 200s, and again, that's still the swing target on QQQ. So again, what I'm doing here, guys, are my usual, what I call check marks. I wanted to see the major indexes. So far we have the two that are most important to me, QQQ and SPY. And then I did recently mention one of my favorites, and I've been stacking to that, is IWM, the small caps. Small caps are the most rate sensitive, much more rate sensitive than large cap stocks because they're more dependent on financing. And so obviously higher rates is not good for the small caps. And so you can see it's been outperforming the last couple of days, with yields flirting with the 30-year bond, flirting with not just multi-year but even potentially multi-decade highs should it break out. So we'll see. We'll see what happens. I'm sure the Treasury and maybe even the Fed are doing all they can to kind of suppress yields. So that's just something to continue to monitor there. And make no mistake about it, with the Trump's big bloated bill passing the House today, it's saw Treasury yields spike up on that. Obviously, that is only going to add to the deficit if it becomes official. And so we'll see. And we'll see. And maybe it should do that, but it doesn't. So maybe Treasuries go the other way. Again, we'll just have to watch, and it's pretty straightforward. So there's IWM, both below the trend line with a solid breakdown yesterday, below the uptrend line. So that's 3 check marks. All on the main indexes I trade and follow: SPY, IWM, small and large caps. You can trade the mid caps. You'll probably see the same thing if I put up MDY. That's the mid cap ETF. But again, this was just a beautiful short the other day. You had this near-term trading range. Give it to you on this board here. I told you we had multiple reasons to short the smallies, and I'll maintain it. And even now, I don't think that it's too late. Obviously, I wanted to got in there earlier. I don't like chasing things, but I will say, as long as we remain below the primary downtrend line, the 200-day moving averages. Right now, you've been rejected off the exponential, the red line there. Multiple rejections. I highlighted that the other day. And now we've broken down below this recent trading range as well. Now, there's a big gap that just got filled. Traders love these gaps. I would be surprised, not shocked, but surprised if they didn't come in at least have a minor reaction buying the gap. That's what traders do. That's what I do. There's the gap right there. So it works like this. So far it's been a minor reaction. I just zoomed down to the 60-minute chart. Right there is the gap, and there's the minor reaction. If we go down on through there without much more than just this, that's the most bearish thing, to get just that brief reflexive buying right there, some short covering. Wouldn't surprise me in the least to see it bounce. Again, what I don't want to see is a pop above the trend line, a pop above the 200-day moving average, the exponential first, then the simple, a pop above this trading range. All that says stop adding if anything starts scaling out of the IWM short. Again, if you're playing the long game. When I highlighted this the other day, I didn't even give you near-term targets because it's a re-entry for your longer-term swing trade for much deeper targets. But you can certainly trade it as a more active swing trade. And again, we're right on that gap now, a hair above it. So if you took it the other day, you made a quick whatever it is. Again, there were multiple entries highlighted recently on this. It's about 4%, nothing big. But, in a market that's kind of grinding around, momentum is stalled out, we're overbought. Upside seems to be limited. I do like the RR to the downside. I think it's skewed to the downside now. What does that mean? I think the next 5 to 10% move from where we stalled out recently is much more likely to be on the downside than the upside. But again, sometimes markets can become more overbought. So that's not a definitive statement. It's just my analysis based on probability and likelihood of what's likely to happen. So that's it. Let me pull this line down here and just put it at the gap, so we know next time I update that. Again, there's the gap backfill. This is the next support. I'm going to tweak my lines right there, and then somewhere around, I'm just going to pull. I'll just leave it there. This is really probably if these levels are taken out, if they break 201, then 196. We probably go down to here about 189. Anything below there, I think, is lights out if that happens. Even though that's the low everyone will be talking about, we get anywhere near it, I think you'll just see the market start the selling begin to accelerate. Okay, pushing my getting close to the 10-minute mark. Let me move on. Sectors. Oh, before I get to that, let me just cover the VIX real quick. Somebody asked. Hey, do you have mind posting a chart with VIX targets? I don't mind at all. I just kind of recap. I know there's always new folks coming to the site. I've been covering the VIX frequently lately. And so my reply here, just real quick, for those new, or a refresher for those that aren't, as you cannot trade the VIX directly. You can only trade futures or options on the VIX. I'm talking about the VIX Volatility Index, or various ETNs or ETFs that track the VIX, or I should say more closely, the ETFs and ETNs use the VIX futures to track the VIX. So I've been using VIXY, which is the VIX short-term futures ETF. It's the trade idea proxy. It has been a longer-term swing trade idea since right around the time it bottomed, and my targets haven't changed, although we've had the opportunity to micromanage that trade by booking profits and or reversing to short as each of the first two targets were hit. Most recently, I've shared a scale back in zone with which VIX briefly and relatively slightly dipped below. Again, relative being the key word here. But it's now back into that zone. So that, coupled with the recent sell signals on QQQ and NQ, the NASDAQ futures, SPY, ES, IWM, everything I just covered, that makes it objective to start scaling in for those that don't currently have a position. So here's the chart. Again, it's under the comment from the last post I made yesterday. And I actually mucked up drawing this arrow. We went long here before in anticipation of the breakout based on 60-minute chart, everything else. We were literally long as we were on this trade before the breakout even occurred. And I think you'd be hard pressed to find, any service out there that's traded the VIX like this. Hit my first target, pull back. Before we got there, I gave you a scale back in zone, this purple box. We hit the bottom of that. We went up to T2. Again, say the reaction's likely. Pulled back. This is the most current scale back in zone, the purple box. Again, we came a hair below it, but hit my S2 level almost perfectly. S2 meaning support right there. Here, I can't zoom in because I'm just on the expanded box. And that's it. If it continues to play out, then this is T3. We've had T3 since we first went long back here. Give you 1, 2, 3 targets. And as it says in the FAQ page on the right side of the chart, the reason I list multiple targets is because upon the initial tag of each target, reaction is likely, and therefore traders may want to manage that trade, book profits and or short, and cycle it this way. So now sometimes and quite often my final targets aren't hit. There's no guarantee T3 will be hit. Maybe this is it. And so, hopefully you book some profits, even made some more money on the pullbacks on short. But if it is, the only way it's going to be hit, let me go to the live chart because that's the one I posted here. The only way it's going to be hit is if I'm correct on my call that this rally is about at the end of it. Maybe it's run its course already. And we're going to take a new leg down the market that's probably going to undercut the recent lows or get even close. Like I said, you get even close to those recent lows, you're going to have traders freaking out. You're going to have a lot of folks buying puts. The VIX, the methodology is based on put and call buying on the S&P 500. So it's that simple. So there it is. We're back into, as you can see here, here's my purple little zone, the box right there. We're back into it there. But again, if you already had your allotment, and again, if you're like me, you're waiting for the market to lose the S&P and the NASDAQ to lose the 200 days, the VIX is going to have walked up there. So again, to me, it's still not an all-in moment. Short the market on long-term accounts, the long-term swing trend trades, nor is it an all-in right now on the VIX. But the VIX is at support, a little bit above there, back into that trading scale-in zone. And so whether this happens or not, we hit that final target, again, it's going to depend on whether these recent sell signals I just gave you stick, number one, without the market going to new highs and just shrugging them off. Again, that wouldn't surprise me in the least. It's not what I expect, but it wouldn't surprise me. There's a lot of strong bid right now in the market. Dip buyers have been buying aggressively. And that's it. Let's not overanalyze it. It's like any trade. You take it. You don't get emotional. You set your stops or have a trading plan. And again, to my opinion, don't go heavy. I think the folks that kind of get upset, on any trades, any of the trades here that go south, probably have put too much money into that one particular position. And all along, I have not waffled, wavered. It's not been an all-in for the long-term positions yet. And won't be until we drop back below the 200-day moving averages. And again, the VIX will probably be up here more, but if you had a starter position you started, At that point, you'd be adding, and there's still, I mean, even if we hit T3, and I may adjust T3 over time, these ETNs will drift, if you will, away from the actual VIX volatility index, but that's about another 100% return from where we're at right now if that T3 level's hit. So plenty of meat left on the bone, even if the VIX is up here, and that's where you decide to add your final lot. And if it goes the other way, well, that's what stops are for. You guys know I've spent a lot of time talking about what will be, you know, what chips away at the longer term bearish case, each of the technical events that might do that. Okay, I've got I hit the 15-minute mark. All right, no big deal. We're almost done. We're going to go over the top sectors of the S&P 500. Let me do that real quick. Remember, when I go through these sectors, there's a total of 11 sectors in the S&P 500. The bottom ones, like basic materials, utilities, REITs, they matter great if you trade them, but they don't mean squat as far as the index goes, as far as weighting, because the S&P 500 is a market cap weighted index, like the NASDAQ 100. So I always talk about I go through these in order of weighting, and every now and then I update these, and it changes over time a little bit, but tech has always been by far, without a close second, the largest sector in the S&P 500. So you put a higher weighting here. It's 1/3 of the weighting. Again, there's 11 sectors, but this one sector gives a 33% weighting to the performance of the stock market of the S&P 500. So and I just want to give you an update there. Check mark. Pending but not yet occurred bearish PPO crossover. Again, one way to view that, if you put up a PPO histogram, you can see when you have, especially when you're in trading ranges like this, don't pay a lot of attention to PPO crossovers. You want to use them when there's a clear trend, a bear trend like that. There's your bullish crossover right there, came right off the lows, or a big hill like this when you have there's a bearish PPO crossover right there. You had a leg down. We were grinding around here, but you finally had one that stuck right there, came and gave you that trend change. There was one counter trend rally which we gamed, and look at the PPO histogram. Again, it's just showing crossovers of this line, bullish and bearish. And then it said, okay, right when we rallied back in the markets, QQQ to the 200-day and SPY, it flipped back to bearish, and we were short for the reasons of my bounce targets, but that coincided with that. So you can see how perfectly this thing has captured the bulk of the trends, long, short. And this has been something I'm watching. It hasn't yet crossed, but there are times where it looks like it's going to cross, like right here, and the lines kiss, and it keeps the trend going. But more often than not, you don't have to be an expert. You can see it. This is momentum waning. You can anticipate a bearish cross when it's going to come. Again, this one hasn't happened, and it may not happen. The lines could kiss, but if it does, that will be an additional check mark. So I'm watching these. We already got the sell signals with the breakdowns below trend line support. Well, now we need to see the bearish crossovers, and that will give me an additional check mark. Financials is second largest. Somebody asked about FAS today. I put that on the front page. Due to the decay, I don't chart the 3-time leverage, even if I decide to trade those. XLF, as I covered in video recently, broke down. It was one of the first to break down. It back tested for a couple days, rolled off, and then what I like to see after a back test is an impulsive rejection. So there's a check mark there. I mean, the first check mark came on the breakdown. Then when we started back testing, this was a second check mark, an impulsive rejection. And now you can see these lines are poised to cross. Any more downside, you will have a bearish PPO crossover in the financials, or not. Again, it's not the most common, certainly the less common thing when you see the lines. Sometimes they'll flatten for a while and then cross. On rare occasions they do bounce, meaning you go up, make a higher high, but it's usually inevitable. When you get overbought, PPO's high level like this, that cross is going to come. So at most you get something like that. Either way, that's check marks across the board for me on the second largest sector. About, again, it's half, makes up less than half of what tech does, but it's still a very important sector to both the stock market and the economy at about 12.42% weighting. XLV healthcare, in a bear market, by all means, divergent low recently. I gave you some targets the other day. I didn't share them when I first posted added this to the chart, but I did cover it in the video yesterday. We hit what's the T2, put on this chart back on the 15th, and we pulled back. So if you like this sector, now you're close to the that divergent low. Remember, in a bear market, divergent lows and bullish falling wedge breakouts and bullish patterns they're bear food, they're bear traps. So just keep that in mind, that this thing is in an unmistakable, unarguable downtrend when you look at it from a longer term perspective. But one of the better looking ones. You put a gun to my head and said, Randy, pick a sector to be long in the S&P 500 right now. This would probably be my top pick, or one of them. So either way, that's the third largest sector in the S&P 500. And then XLY, check mark there yesterday, breakdown. And then XLC, communication sector, broke down the other day, closed right back on it, breakdown. I always say if you have to squint, give it the benefit of the doubt. In other words, that's you want to jump on that sell signal. Pretty good rejection yesterday, and you can see right now we have this little area of a confluence, a little trading range. So you need to pop below there. That'll be your next check mark. There is a check mark because we broke down and we're well below the trend line. So again, collectively, this is how my brain works with this stuff. The more check marks I get, meaning the more indexes, if I see SPY break down but not QQQ, then I'm going to hold off, or not be as bearish, or maybe hold off on a short trade. If I see, at this point, when I go to the top 5 or 6 sectors in the S&P 500, the ones that have the biggest weighting, and this is the last of them that I've been covering recently, I believe, XLI, industrials, clear, solid breakdown. I don't have to squint to see, and it's a very well-defined uptrend line. So that's it, guys. I have check marks across the board. I know today the market started to go down, and then it came back up, and we're actually positive right now by a hair. That doesn't in any way, shape, or form. I say this because I can see and I feel from the comment section there's a lot of impatience, and I make a lot of terms up in trading and investing. One of them is, as I like to say, in life they say patience a virtue, right? You've all heard that saying. I say in trading it's an absolute necessity. Now, if things start to change, and you guys know my plan, I've already started to on the long-term accounts scale. I took a quarter position out when we took out the 200-day moving averages, about 2 trading sessions after. And I may still take another half or more out, which is still a fractional position. And I'm talking for those new, my plan was all along, long here, sell longs. We had a pullback trade, re-entered longs, and then started scaling back out to close out the longs, and then started scaling into here. And I made it very clear all along I would, even though I could see easily the market's going back to the top of the range, even though I had the box there was 500, always it was the bottom of this trading range, it was to not add. That was my no-go level, and it has remained my no-go level. Somebody made a comment yesterday, I saw a lot of thumbs down. I've made very clear to me there hasn't been until yesterday, or was it the day before? I gave you the recent QQQ short, the pullback trade, the swing trade based off the 60-minute charts. This has been a no-go, and I haven't added a short trade, made it, has not been any reason, in my opinion. The only trades to be made on QQQ or the markets were to scale out of positions as we kept getting farther away from the 200s. But then recently we stalled out here. That was last Thursday's high. And we have this little trading range going on here, and we're now down below that trend line. And so what we need to see, everything that I showed you before, go out to this chart here, 60-minute chart. We were below it in pre-market by a hair. We're hugging that 514.39 support that I gave you the other day. We're just on it. We're at 515.36. That's basically right on it. SPY, I gave it to you as that 588.60 did get taken out. You can see the S&P 500 underperforming a little bit today. There's the sell signal and the wedge break, and that's it. So we need to now, SPY needs to take out that trend line. There, let me move that gap up a little tighter. Here's your levels right there. Again, traders love these gaps. You set these lines on the gaps. So these are the trend line comes in with the top of this gap right here, 577.72. So that would be a check mark there if taken out, if and when. And on QQQ, again, that one's on this board here. Get a little flagging type action. So I suspect we'll close red today. I called for red close yesterday at the end of that video, and we were right at the highs of the day. And sure enough, by the time I got that video out to you, we had the big drop. We closed red for the, second day in a row. Again, nothing big. That was 2 red closes, and obviously I'd like to see a red close here because we've still got some meat left on that trade if it's going to play out. And I gave you guys a stop. It was drawn in by hand wherever that was, I think 533 if you're only targeting T2. And again, just to, once again, to speak to both that's the short-term swing trade idea, long-term swing trade idea, nothing has changed. If you are keeping your eye on the prize is T7 here, my final target at 260.56, which if hit, and again, always a big if, the odds will start to go up if we continue down. We take out the 200s, but that's a 50% drop from where we're at right now. But again, like all my trades, I micromanage these things. We covered there when this T2 was hit on the August, right at the lows there that day, August 5th, I think it was. And then again, we were covering leading up to, and then at that point, that day, August 7th, that's where I stated no more longs. I mean, no more shorts, only longs, no hedges, ride it up. So that's swing and trend trading, you know. And I promise you too that if we go down to T7, I will have plenty of counter trend longs along the way. That's whether it's a bull or a bear trend, that's what swing trading is all about. If you want to invest, go buy an index fund and go spend your time out on the golf course or whatever you like to do. No reason to sit in front of the computer if you've got that 10-year horizon. If you're in a swing trade, no matter what the trend is, bullish or bearish, there's always money to be made on the long or short side, and that's what we're trying to do here. So, all right, let me wrap it up here. Again, the takeaway is boom, 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 boom. Check marks across the board on those trend line breaks. It doesn't guarantee anything. That's what stops are for. But as of now, this trade still looks good. I'll give them points for holding it up here on this support as long as they have so far. So really right now, you just need to see today's lows get taken out. That should do the trick to open the door to T1 and then T2. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.